Hi investors! Over the past multiple months, the market has remained fairly strong. So today we're going to deep dive into the current market situation and see whether the market is bubbly. Look at these beautiful charts. Markets across the world are experiencing historical highs. These include US and Indonesia, whereby the stock market indexes have reached all-time highs as of September 2025. Naturally, it brings us to the question of whether the market is overheating. In order to judge whether the market is bubbly, let's quickly take a look at valuations. S&P 500's average PE ratio since 1990 stands at 17.9 times, while the current PE ratio stands at 25x. So one might judge that the market is quite expensive. However, this chart tells us an interesting story. There are only few moments that S&P 500's share price movement hover around the historical average. In fact, the price movement shows tendencies to remain above and below average for a prolonged period of time. So there is little to no correlation of the current PE ratio and the direction of the price movement. However, from a secular viewpoint of the stock market and corporate earnings, we can see that corporate earnings and stock price shows synchronized trends. In this log scale chart, there are times of stock market overshoot and undershoot. However, given the nature of stock market moving ahead of the actual corporate earnings, we think that corporate earnings will justify the price movement going forward. Now, let's discuss about how bubble is formed. In the book, Manias, Panics, and Crashes, Charles Kinderberger outlines the 5 phases of a bubble. Phase 1 is displacement. This is a stage when innovation occurs that sharply changes expectations. Phase 2 is expansion. In this stage, numbers mean less and narrative take center stage, and investors start bidding up asset prices. In phase 3, everyone is excited and they think they can quickly get rich. They become risk complacent and they become full-time day traders because they think they can get more money trading than going to their jobs. And you reach the crisis phase where the bubble explodes. Insiders start selling and panic selling is now the mainstream. Last phase is the contagion, where most investors became fearful. So we came up with the 3 preconditions for a bubble, which are displacement, liquidity, and excitement. The first condition is displacement, whereby radical innovation shocks the market. Looking back at the bubble burst of the 1929, 1999, and 2020 boom-bust cycles, they all had one common denominator: something new. In the 1920s, we had new innovations such as the radios, telephones, and cars. Radio Corporation of America's share price trend shows an amazing spike followed by a crash. During the 1990s dot-com bubble, market went crazy on internet. Share prices of Qualcomm, Intel, Oracle, Amazon exhibit huge swings. During the COVID-19 bubble, everyone was stranded at home and the market was overwhelmed by the FANG stocks. So where are we in the bubble cycle? We observed past boom-bust cycles of the dot-com and FANG and compared them with the recent AI innovation. We took January of 2023 as a starting point of the cycle, given this was a time when Microsoft announced multi-year $10 billion investment in OpenAI, a key milestone for ChatGPT. All 3 charts show synchronized trends. At T plus 27 months, there was a correction. During the AI innovation cycle, that was March of 2025, the Liberation Day pullback. And now we're at T plus 33 months. Since this is a log scale chart, we can see that we remain above the FANG boom, but lower than the dot-com boom. We would probably have to expect a second correction in August of 2026. However, after the second correction, there is another bull run up to T plus 62 months. Typically, innovation bull cycle lasts up to 5 years. So, if history is any reference, the peak cycle of the AI cycle should come sometime during 2028, followed by a crash. Next precondition is cheap money. However, there is an important aspect to this. There has to be a mismatch. So, the overall economy has to be in a bad condition, but certain sectors that drive the innovation should have a strong footing. The bad economy gives central banks good reasons to cut rates, driving liquidity higher. And the sectors driving the innovation will benefit from this liquidity-driven market. During the dot-com bubble, economy was in a bad shape, and the collapse of long-term capital management, LTCM, gave the Fed very good reason to cut rates. This fueled the share price of tech companies to form a bubble. During the COVID crisis, economy was hit hard by the virus, prompting global central banks to quickly cut rates. During this time, earnings of Netflix, a member of FANG, was in a good shape. Money became cheap, and this enabled FANG stocks to create a bubble. Now, where are we in the rate cut cycle? Well, there's lots of debate surrounding the condition of the US economy. However, the fact is that Fed recently started cutting rates, and M2 growth is growing at 5% YOY. Compare this with COVID crisis, and Fed funds rate is nowhere close to 0%, and M2 growth is far below the peak growth rate of 27%. Simply, we are unable to conclude that the market is overly liquid at this point. Last precondition is euphoric investor activity. We take two indicators of investor excitement: margin loans and IPOs. Observing past trends, margin loan balance of US securities companies stand at $118 billion, which is far lower than that during multiple crises, including dot-com bubble of the 90s, global financial crisis of 2008, and COVID crisis in 2020. Also, the number of US IPOs stand at 285 as of October 2025, which is far below than that during the COVID boom of 1,035. So, are we in a bubble? The conclusion is no. Preconditions are brewing, but it's not strong enough to call it a bubble. Innovation is driven by AI, but in terms of rate cut, the Fed just started cutting rates, and there is little evidence that investors are overly excited about the market situation. So, when does the bubble burst? We observed 3 past bubbles. The time it took the market to reach the peak of the cycle was 17 months during the dot-com bubble, 22 months during the COVID bubble, and 25 months during the 1920s bubble, since the last rate cut. As mentioned earlier, Fed has just entered the rate cut cycle, and the Fed will still remain pressured by President Trump to squeeze rates further. According to current implied Fed fund rates, the last rate cut is likely to happen in April of 2027. However, as discussed earlier, there is lots of debate of whether the economy is really bad for the Fed to cut rates aggressively, right? Assuming rate cut probability of over 80% in the Bloomberg consensus estimates, the rate cut is likely to continue until December of this year. From December of this year, we apply 17 months to 25 months, and the peak cycle should somewhere be around mid-2026 to end of 2027. So, what does this all mean for Indonesia? Indonesian stock market is a more stable market, and share price shows high tendencies to hover around the historical average PE ratio. We witnessed a sharp spike during the COVID pandemic, and we don't rule out the possibility of current bull cycle to replicate that rally. However, in terms of PE valuations, we are at 20x as of September 2025, which we consider to be far from a bubbly market. Now, let's take a closer look at the preconditions for a bubble. We will not consider the displacement factor given AI innovation is a common denominator. Our focus will be centered around liquidity and investor hype. Observing BI rate depicted on the upper left-hand corner, Indonesian Central Bank is at the mid-cycle of a rate cut towards the COVID pandemic cut. So, if BI were to cut rates further, there is still ample room to cut. M2 growth is growing at 7% YOY, which is far below the M2 growth of 14% YOY seen during the COVID-19 pandemic. On the upper right-hand corner, we have the theoretical non-institutional margin loan balance of broker code CC. Margin balance has indeed spiked since 2024. However, considering the margin balance against the broker's total transaction, we think it remains far below past bull cycles. On the IPOs, we do not see any evidence of market excitement. Then, how should investors invest during the liquid market? First strategy is to concentrate. During liquid markets, we strongly believe alpha is generated through stock picks. So, it's imperative to concentrate your investments rather than manage a portfolio of stocks. Liquidity is back, and so are retail investors. According to the latest data from IDX, we can see that the number of investors jumped during the COVID pandemic, and recently we are seeing another meaningful jump from 1.7 million to close to 2 million. And in line with increased investor participation, retail transaction has jumped from 33% in 2024 to 47% as of September 2025. Retail investors tend to look at the narrative of a certain stock rather than the fundamentals. Indeed, if you take a look at the right-hand chart, you can clearly see that if you manage a portfolio of stocks like the JCI index, you will significantly underperform. Also, during a liquid market, stock selection is critical. If you compare the stock performance of BRPT against BBCA, the gap is quite staggering. So remember, it's a stock picker's market. Secondly, buy and hold key sectors. During liquid markets, leading sectors continue to remain leaders, and sector rotation doesn't happen so easily. This is because investors tend to concentrate their investments, and the narrative is stuck on investors' mind. Buying expensive stocks may feel uncomfortable, but they definitely generate return for you. In this cycle, we highlight 4 sectors for you to concentrate, namely technology, energy, basic materials, and industrials. Also, special mention sectors are infrastructure and property, real estate. The last strategy is to look for opportunities within the mid to small cap space. During liquid markets, share prices of leading sectors tend to be unrealistic levels. This will prompt investors to look into mid to small cap space, which will become the next large cap stock. This trend was evident in past cycles and is starting to show similar trends this time around. On the left-hand log scale chart, we have ARK-K, an ETF focusing on small disruptive innovators, against Russell 2000 and NASDAQ. ARK-K exhibits greater volatility to the upside and downside during boom-bust cycles. And recently, ARK-K has started to outperform the Russell 2000 index. On the right-hand log scale chart, you can see the price performance of BBYB, a relatively small cap bank compared to BBCA, has been on the rise, supported by improving earnings performance. So the moral of the story goes like this. We are not in bubble territory yet. The preconditions are coming into place, but we don't judge the market to be bubbly and see more upside room to fill. Secondly, if history is any indication, the peak of this rally should be somewhere in between mid of 2026 to the end of 2027. How should you invest during this liquid market? First, concentrate. Second, buy and hold key sectors. And thirdly, look for opportunities within the mid to small cap space. Lastly, at Samuel, we have lots of interesting stock ideas that we're going to unfold going forward. So please like and subscribe to Samuel Sekuritas. Thank you.